Next, we're going to introduce Patrick Tremblay. He is a seasoned executive in the financial services industry with a career spanning over 3 decades. His career journey began in 1989 with various positions in increasing responsibility at RBC. He honed his skills and built a solid foundation in financial services. His extensive background has equipped him with a unique blend of strategic vision, operational expertise. He currently serves as the VP of Residential Lending at Dominion Lending, National Simpson & Associates, a role he has held since December of 2022. In this capacity, Patrick oversees all aspects of residential lending, leveraging his extensive expertise to drive strategic initiatives and deliver exceptional results. Prior to his current position, Patrick was the Regional Vice President of Mortgage Specialists, RBC, from January 2010 to September of 2022. In this role, he was instrumental in leading a large team of specialists, enhancing customer experiences, and achieving significant business growth. From November 2005 to January 2010, Patrick served as the Regional Vice President at RBC London. In this role, he was responsible for the retail banking business in London and St. Thomas, Ontario, including branch banking, small businesses, and financial planning. Tonight, Patrick will be discussing factors contributing to high interest rates, ballooning budget deficit and inflation, housing market and mortgage interest rates, as well as mortgage trends. Please welcome Patrick, everyone.
I don't know if I need that. Can you hear me back there? Or do you want me to use the mic? We need the mic. Okay, all right. Well, good evening, everyone. Thanks for joining us today. As Tammy said, I want to discuss the current interest rate environment in Canada, which obviously is a topic of significant importance given its impact on the economy, housing market, and personal finances of Canadians. So what is driving the rates up so high and so fast? We all know and we all feel how fast the rates have gone up. And so what is driving it? First and foremost, it's inflation control. These rate hikes are part of the central bank's efforts to bring inflation back to its target range of 1% to 3%. High inflation erodes purchasing power, affects living standards, and can destabilize the economy if left unchecked. These higher rates obviously affect mortgage rates, making borrowing more expensive for home buyers. This has obviously led to a cooling of the housing market with reduced home sales and slower price growth in many regions. In fact, I've read recently that we have the lowest sales in the last 28 years in Canada in new home sales. Think about that. 28 years ago, there were millions less Canadians, and we're at the lowest point in 28 years. Clients with variable rate mortgages have seen their monthly payments increase, while those looking to renew fixed rate or non-adjustable rate variable mortgages face higher rates compared to previous terms. For businesses, including home builders and suppliers, the cost of financing new projects or expanding operations has risen, which may lead to more cautious investment decisions, i.e., wait to build later, as Vito said. So what is the path forward in terms of the housing market and mortgage interest rate trends? I'm going to rely heavily in my remarks on some information that I gleaned from a subscription service called Mortgage Logic News, and it's authored by Rob McClister. Many of you will know his name from the Globe and Mail, and he was also a co-founder and owner of RateHub at one time. So where are we going? It feels just like yesterday that higher for longer was going to be the cliche in the economic circles. But after Tuesday's CPI improvement, people might flip that phrase on its head. Borrowers got the CPI print they needed to pave the way for a Bank of Canada cut on July 24th. Headline inflation clocked in at just 2.67%, its lowest in 3.25 years. Most of the media reports round up the 2.67 to 2.7, but it was actually 2.67. Moreover, as economist David Rosenberg pointed out on Tuesday, when you take out mortgage interest costs, and what is that doing in CPI anyway? Anyone tell me? I don't know why that's in there. Inflation in Canada is running at just 1.9%. With the Bank of Canada gearing up to ease once more, the bigger head scratcher is, What's the game plan post-July? Well, here's 10 quick facts on that. Inflation has clear downhill momentum, as evidenced by Tuesday's 2.67% headline inflation print. Inflation expectations plunging in the latest Bank of Canada surveys, which were released on Monday. Average core inflation has been following a reasonably tight trend line since the June 22 peak. Markets now expect another 200 basis points of Bank of Canada cuts from here. Last week they were predicting 175 basis points. This week it's 200 basis points. Unemployment is gaining upward momentum, a classic move at this stage of the business cycle. So bad news on the employment end is good news on the interest rate trend. Inflation watchers can expect helpful Canadian base effects in the next 2 months, so meaning July and August, where they were higher last year, so the year-over-year base effects will be favorable for the CPI. The Bank of Canada has already hinted at several more rate cuts. 3 out of 4 indicators the Bank of Canada really focuses on, excess supply, inflation expectations, and corporate pricing behavior, are heading in the right direction. Wage growth is the 1 in 4 that's not, but wages are a lagging indicator. Barring a crisis, the overnight rate will remain restrictive and disinflationary for quite some time. Even against the Bank of Canada's 2.75 estimated midpoint neutral rate, Canada's policy rate today towers 200 basis points above that. Renewals at steeper rates are still occurring fast and furiously and will only accelerate more in 2025, which is creating a vacuum for discretionary income. And 10, inflation usually rises and falls with a degree of symmetry, which suggests we're potentially just months away from core inflation being closer to the 2% range than the 3%. As a result of the above, the Bank of Canada should look right through last month's disappointing CPI bombshell. As economist Rosenberg put it, the May bump in Canada's CPI was an aberration, pure and simple. By Tuesday's market close, markets were pricing in 2 to 3 more rate drops before year end. And this is where things, when you're trying to predict interest rates, it gets a little, interesting because people have differing views on that. And sometimes they're built on hope, some are in desperation, mostly on fact. But we did have some sobering, less dovish points in this week's, what they were calling the Party Pooper Report by Derek Holt, a renowned economist. And he thinks we may see 2, not 3 more cuts this year. Because when you take a look at the Bank of Canada's measure that they like more, which is the seasonally adjusted annual rate of inflation, there were 4 indicators that were a little hotter than he would like to see. So again, a dissenting view versus some of the others is Derek Holt. Nonetheless, we should see rates start to come down in the next several months as we move forward. So when we take a look at what is really causing inflation and some of the bigger issues that are out there, I want to talk a little bit about ballooning budget deficit and inflation. So Kevin Aberbanel, who is a former head of futures trade at BMO Nesbitt Burns, and a noted expert on what drives Canadian mortgage interest rates. So this is his quote recently, and he's saying, "I just renewed my mortgage the day after the last Bank of Canada meeting and did a 3-year fixed," he says. "I don't think rates will go down as much as possible as people expect. Inflation will likely be more problematic than they think. The fiscal deficits they're running have such an inflationary effect. We're not even in the middle of it. The national debt is a simple chart that a 5th grader could look at and see there's a problem. The real elephant in the room is the U.S. debt, and Canada is no different. When you take a look at our Canada's federal debt is now over $1.2 trillion, and the growth of that is over $109 million a day in our debt as we move forward. And your biggest buyers at the bond auctions, the central banks, are gone. Bond auction supply is enormous. And he says the U.S. and Canada risk falling into a long-term debt spiral if they don't get spending under control soon. The one foolproof indicator was the 2s and 10s. If someone would have said in 2021 that rates would go from 0 to 5%, you would have thought for sure we'd go into a recession. It didn't happen. And the 2s and 10s refers to the 2-year Treasury, U.S. Treasury, and the 10-year Treasury bonds. This spread right now is inverted, and it's negative 32 basis points in Canada and negative 28 basis points in the U.S., which has historically been a sign of the coming recession. The only logical place to get to is that we all weathered the storm because there's been so much money put into the system through government spending. Government debt is hard to look at. The magnitude of the increase is so dramatic, I don't think they land it, he predicted honestly, meaning I don't think they land a soft landing and avoid a recession. That said, if there's one thing that Abravanel is fairly confident of, is that the new neutral rate won't be the 2.75 that we're reading about. So by locking in for 3 years, he suggests that the Bank of Canada's 2.75 midpoint neutral rate estimate may be wishful thinking for the reasons above. I guess we'll see. Trying to give you a balanced view in terms of where people are seeing the rates moving as we move forward. And Vito already covered off sort of immigration and how that's impacting housing. So that's really all my remarks that I want to have as it relates to the interest rates and sort of where we can see things moving in the near term. But just a couple of things that I'm seeing, and I know we got a lot of mortgage agents in the room here today as well. Just some trends that we're seeing in the mortgage business right now. Seeing a lot more second mortgages from alt lenders behind A lenders to clear up significant credit card and HELOC debt. These huge interest rate increases are killing people. And those people who drove up their home equity lines of credit during the pandemic and shortly after as funds are drying up from their savings, the interest rates are really, really hurting them right now. And many have run up significant credit card debt, and they can't afford to go to their bank and because their ratios are out of line, so they have to go to an alternate lender to free up the debt to pay out the high interest debt. It's still a significant amount of interest that you're paying, but it's a lot less than the 28% they're paying on their credit cards. We're seeing a lot more private financing for bridge financing to help both close new construction mortgages that are now ready to fund, and also for transactions that when you had a firm sale, that's no longer firm, but you're committed to buying your new house, and so now you need to bridge that. They can't. I almost did it, Vito. You can't. I'm French. We speak with our hands as well. They can't. Their bank will not finance the bridge because their ratios are out of whack. So we have to go to a private lender to help bridge that and close the transaction. And as per some of my remarks around, what are people choosing in terms of a term for rates right now? By far the most popular rate is 3 years. In our office, we're seeing the 3 years the most popular rate being chosen by the borrowers. And we're also seeing a lot stricter lending criteria for home equity lines of credit mortgages by most of the lenders